Lo tengo. Voy a adaptarlo al inglés, aproximadamente 4,000 caracteres, estilo SkillStack. Most people are waiting for the wrong crisis. They're expecting another 2008, a historic crash, the AI bubble popping. They're patiently holding cash, waiting to buy the dip and pull off their own Michael Burry moment. It sounds logical. The problem is that logic only works if the next crisis looks like the last one, and it doesn't have to. The next big hit might not be a deflationary crash like 2008. It could be the exact opposite, an inflationary crash. A scenario where prices don't collapse, but your money does, why everyone is still waiting for 2008. Because 2008 is the last great collective reference point for financial fear. Credit dried up, liquidity disappeared, banks stopped lending, assets collapsed. It was a deflationary crisis, and in that environment, holding cash gave you power. So today, millions of people are running the same playbook. Everything's overvalued like 2008. I'll hold cash, wait for the crash, and buy everything cheap. The problem is the system today works very differently. What has changed? Debt between countries, banks, and individuals is far higher than it was in 2008. The economy is far more dependent on credit. This means the financial system tolerates asset price drops much worse than before. When asset values fall, the collateral backing all that debt weakens, and confidence collapses fast. So when serious tension appears today, the response isn't usually, let everything fall. The response is more liquidity, more stimulus, more intervention. When you inject liquidity to stop markets from falling, the amount of money grows faster than the real value of the economy. And then something important happens. Prices start rising, not because everything is better, but because the currency is worth less. What is an inflationary crash? This is where most people get confused. They see stocks rising, gold rising, certain assets climbing, and think, this is a bubble. But sometimes the right question isn't why assets are going up. The right question is, what is happening to the money we're measuring them with? When a currency loses purchasing power, any scarce asset starts looking more expensive, not because it's better, but because there's more money chasing the same assets. That's what can create an inflationary crash, and it's the most dangerous kind because it doesn't arrive with a dramatic event. It's a war of attrition. Everything seems expensive. Living costs more. Cash loses strength year after year. No single alarming headline, just a slow, progressive erosion of financial comfort. The reverse crash checklist, 3 signals to watch. Signal 1, capital concentrating in a handful of giant companies. The market looks healthy, everything seems to go up, but only a few enormous companies are driving the index. That's often not economic health. It's capital fleeing the government currency. Smart money knows the currency loses value daily, so it moves into dominant businesses as a store of value. Signal 2, explosion in scarce asset prices. Art, collectibles, limited objects, prices going insane. Most people interpret it as consumer madness, but it often reflects something deeper, people preferring anything scarce over a currency that's losing value. When a Pokemon card sells for $500,000, it's not just irrational, it's a signal. Signal 3, very different assets all rising at the same time. S&P 500 gold and Bitcoin, stocks, traditional safe haven, and crypto, all going up simultaneously. When everything rises together, it's sometimes not that everything is wonderful. It's that the market is growing against the currency. The common thread between all 3 signals, distrust in government money. What to do when cash loses value? In an inflationary crash, the priority is protecting purchasing power. That means staying diversified in quality assets that are tied to inflation. The best ones are businesses that sell real products and services, because when inflation rises, they raise their prices. They're anti-inflationary by their own nature. The biggest mistake is staying trapped in too much cash, waiting for a deflationary crash that may never come, or chasing safe haven assets like gold after they've already run up massively. The uncomfortable conclusion, the problem isn't just that a crisis is coming. The problem is preparing for the wrong one. If you're waiting for a deflationary crash, accumulating cash, and waiting for bargains, but what arrives is inflationary erosion, that wait becomes a trap. The next crisis might look nothing like 2008, and if you keep waiting for the same scenario, by the time you react, you might realize it wasn't the market leaving you behind. It was the lack of the right framework.